Welcome to Griffonomics.
Glad to be here.
Usually when we look at a company with like a near monopoly on its primary product, and they have this backlog of guaranteed government orders stretching into the tens of billions, we expect the narrative to be pretty straightforward.
Oh, yeah, completely. You'd expect compounding returns, predictable dividends.
Right. High fives in the boardroom all around.
Yeah.
But then you look under the hood of America's largest military shipbuilder, and suddenly that clean narrative gets, well, incredibly messy. So welcome to our deep dive. For everyone listening, we are thrilled to have you with us today as we bring you a granular shipyard stress test analysis of Huntington Ingalls Industries, or, HII.
Yeah, and we are taking a really hard look at a massive stack of sources for this one. We've got their Q1 2026 earnings transcripts, their SEC 10K and 10Q filings, alongside some really deep forensic financial analyses and the latest defense budget reports.
Exactly. And the core mission for this deep dive is to answer one really massive overarching question for you all. We want to know, is HII actually successfully transitioning from this pure heavy metal shipbuilder into a true all-domain technology partner? Or are they currently stuck as a volume giant that has actually just become a massive margin trap for investors?
And, before we really tear into the financials, it's worth noting that our data stack today includes some highly politicized defense budgets and legislative proposals.
Oh, heavily politicized.
Right. So just to be totally clear for you listening, we are looking at this purely as a forensic exercise. Because the sources contain politically charged material regarding defense budgets, I want to explicitly state that this deep dive will cover policies from both the left and the right without taking any sides at all.
Absolutely zero side.
Exactly. Our goal is impartially reporting on the factual content provided in the sources. We're not endorsing any viewpoints. We're simply conveying the ideas that shape the defense industry's operating environment right now.
Yeah, well said. We are just looking at the playing field, not cheering for a team. So to understand the immense stress currently being placed on HII shipyards, I think we first have to wrap our heads around the sheer historic volume of demand.
It's just staggering.
It really is. The top-line numbers for Q1 2026 are wild. They are sitting on a record $54 billion backlog.
$54 billion.
Yeah, and they posted a 1.3 times book-to-bill ratio for the quarter, plus a massive 13.4% year-over-year revenue surge, bringing them to $3.1 billion in just 3 months.
And that 1.3 book-to-bill ratio, that is a really critical metric to isolate early on.
Because it shows the pipeline growth, right?
Exactly. Mechanically, it means for every $1 of finished work they actually push out the door and bill for, the government is just shoving $1.30 of new guaranteed orders right back onto their desk.
Which is crazy.
I mean, normally in literally any other manufacturing sector, building a pipeline like that is a total dream scenario.
Right. But here it's starting to look like a massive bottleneck. The pipeline is just swelling way faster than the drain can empty it. And this is driven by what is essentially a monopoly power.
A total monopoly in some areas, yeah.
Yeah, like HII's Newport News segment in Virginia. They are the sole designer, builder, and refueler of U.S. Navy nuclear aircraft carriers. Like, if the Navy needs a nuclear carrier built or refueled, there is literally only one place on Earth they can go.
One place. And furthermore, they're one of only 2 companies in the entire country capable of building nuclear-powered submarines.
It's a massive moat.
Oh, the barriers to entry are incredibly high. No startup in Silicon Valley is going to suddenly disrupt the nuclear aircraft carrier manufacturing space.
I'd like to see them try.
Right. And that monopoly power is meeting an unprecedented bipartisan political tailwind right now. The documents refer to this as the Golden Fleet expansion.
The Golden Fleet, yeah.
Washington is largely in agreement on the need to maintain U.S. maritime dominance, and the funding really reflects that.
Yeah, we're looking at a proposed fiscal year 2027 budget that recommends a massive $65.8 billion for shipbuilding procurement. And a detail that really stands out in the filings, this includes initial advanced procurement for the lead ship of the new Trump-class battleship program, the USS Defiant.
And the legislative funding goes well beyond just, buying individual ships, too.
Right. It's the whole ecosystem.
Exactly. There is over $29 billion in mandatory funding specifically directed toward the maritime industrial base.
$29 billion.
Yeah. We are seeing a concerted, heavily funded effort to invest in supplier capacity, physical infrastructure, and workforce training across the entire country. I mean, the demand signal from the government is as loud and clear as it gets.
Okay, let's unpack this. Because if they have a near monopoly on a highly specialized product, and they have a $54 billion backlog of guaranteed government orders, plus this universal political support funneling billions into their industry, I mean, they should be printing money.
You would certainly think so.
Right. So why on earth did HII stock drop 14% after they reported these earnings? Like, if the top line is surging like that, why is Wall Street punishing them so hard? What are we missing here?
Well, the stock dropped because investors realize that right now, every new government order actually punishes HII's bottom line in the near term.
Wait, really? The new orders hurt them?
Yeah, the sheer volume is exactly what's causing the margin trap, because when you look past that revenue beat and actually examine the profitability, the whole picture changes entirely.
Oh, wow.
In Q1 2026, their consolidated operating margins dropped 80 basis points down to a critical 5-point-year%.
Which is a really significant squeeze for a company of this scale. I mean,
Yeah.
80 basis points on billions of dollars is huge.
It's massive. But the real alarm bell in the forensic analysis is the cash flow. They reported a massive free cash flow burn of negative $461 million for the quarter.
Negative $461 million.
Yeah. They are bleeding cash just to fund the work they're doing.
Okay, let's drill into the mechanics of that leak. Because where exactly does almost $500 million just disappear to in a single quarter, especially when your revenue is up 13%?
So the forensic documents isolate a major portion of it. There's a $231 million outflow specifically tied to unbilled receivables.
Also called contract assets, right?
Exactly, contract assets. And this all comes down to the really complex billing milestones on these massive Navy contracts. The government doesn't just, hand HII a check for $1 billion and say, call us when the submarine is done.
Right, that would be too easy.
Way too easy. They pay on highly specific physical milestones. So say when the pressure hull is completely sealed, or, when the reactor compartment is finally integrated.
So HII is basically fronting the money. They're buying the raw steel, paying the vendors, covering the weekly payroll for thousands of workers to bid the module, and incurring all of those costs totally up front.
Exactly. They are physically performing the work and loving the expenses, but because they haven't crossed the exact finish line of that specific milestone, they cannot legally send the invoice to the Navy.
Oh, that's brutal.
It is. Those unbilled assets are growing significantly faster than the actual cash they are allowed to collect. So the cash is just physically trapped inside unfinished ships sitting on the shipyard floor.
And, a huge driver of why those ships are unfinished really comes down to the human element here. The filings note that HII hired over 1,600 new shipbuilders in the first quarter alone, which, on a spreadsheet sounds great for expanding capacity.
On a spreadsheet, sure. On the actual shipyard floor, however, it's a very, very expensive reality. It's the cost of scale.
Right.
In heavy naval shipbuilding, you don't just walk in off the street, put on a welding mask, and start building a nuclear submarine.
Definitely not.
The work is incredibly complex, it's heavily regulated, and it's dangerous. So the data shows it actually takes a new hire roughly 18 to 24 months to reach peak proficiency.
18 to 24 months. That's a classic industrial bottleneck. It's like expanding a restaurant and hiring 1,600 new cooks overnight.
Yeah.
I mean, of course, the kitchen slows down and food gets wasted before they actually learn the menu.
That is a perfect analogy, because when HII brings in 1,600 green recruits, the senior master shipbuilders, they have to literally stop doing their own highly technical work to train the new workforce.
Oh, so it compounds the delay.
Exactly. The sheer volume of new bodies actually creates inefficiency and slows down the overall throughput in the short term.
And that inefficiency is severely punishing right now, right?
Yeah.
Because of the specific mechanics of HII's contracts. I was looking at the analysis, and it shows that 46% of their 2025 revenue came from fixed-price incentive contracts.
Yeah, that's a huge risk factor.
But wait, if they are a monopoly, why can't they just pass these scaling costs back to the Navy? Like, a normal monopoly facing labor friction would just hike the price of the end product to protect their margins.
Well, because of how those fixed-price incentive contracts are explicitly structured, the Navy essentially says, we will pay up to $2 billion for this vessel, and if you can build it for less, hey, we share the savings.
Okay, makes sense.
But there is a strict cost share limit on the upside. So if you have an inflationary environment for materials, which we definitely do.
Right, seals are getting cheaper.
Exactly. Combined with intense labor shortages and this incredibly green workforce making mistakes as they learn, your internal costs just skyrocket. So if it
Mm.
costs $2.5 billion to build that sub because of all these labor inefficiencies, well, the price is still relatively fixed.
HII just has to eat the difference.
They have to absorb those massive overruns. The monopoly power doesn't protect them from contractually agreed upon cost ceilings, so their profit margins just get completely crushed.
Wow. And it's not just financial friction holding up these milestones either. There's actual physical execution risk happening. The filings mention test program issues delaying the LHA-8 Bougainville amphibious assault ship.
Yeah, that was definitely flagged.
But the more systemic risk here is an ongoing government investigation into non-compliant welding procedures that they discovered at the Newport News shipyard.
Yeah, and when you have green workers and incredible pressure to produce volume, quality control becomes a massive vulnerability.
Absolutely.
And a government investigation into welding on nuclear vessels, that is not a minor administrative headache. We are talking about the structural integrity of a vessel that will house a nuclear reactor and dive to classified depths.
Yeah, you really don't want a bad weld down there.
Not at all. The regulatory pause required to audit and correct those non-compliant procedures is immense. It totally stops the line, which further delays the billing milestones, which in turn traps even more cash in those unbilled receivables.
So that is the anatomy of the margin trap. They're generating massive top-line volume, but they cannot extract proportional profit because they are completely bogged down by the upfront costs of scaling their workforce and, the friction of regulatory compliance. So, looking forward, how does management plan to actually climb out of this profitability trough?
Well, management has drawn a very clear line in the sand for their turnaround strategy. They've reaffirmed a core operational goal, targeting a 15% increase in throughput by year-end 2026.
15%.
Yeah. They're basically betting that the 1,600 green workers they hired will finally cross that 18-month proficiency threshold, the line will speed back up, and they will get 15% more physical work pushed through the shipyards to break this margin trap.
Okay, but the Q2 2026 guidance provided by management seems to hinge on something very specific to hit that. The filings mention they are relying on a factored rate for anticipated contract awards.
Yes, the factored rate.
What does a factored rate actually mean mechanically? Are they just assuming they will win the bids and kind of baking that into their forward guidance?
This raises an important question because, yes, they absolutely are. Specifically, they are anticipating the framework contracts for the Virginia-class Block 6 and the Columbia-class Build 2 submarines.
Okay, massive programs.
Huge programs. And getting these two on contract isn't just about making the revenue projections look good on paper. It is operationally vital to that 15% throughput goal.
Why is that?
Because in heavy shipbuilding, sequencing is everything. You have to order the steel, the valves, and the reactor components literally years in advance. If HII does not secure those specific submarine contracts in the immediate near term, they cannot maintain the proper construction sequencing in the yard.
Oh, so the whole line gets jammed up.
Exactly. The supply chain stalls, the workforce has downtime, and the entire 15% throughput goal just completely derails.
Man, let's do the math on the cash hurdle here, because if they're burning cash right now, the back half of the year looks incredibly steep.
Very steep.
If Q1 burned $461 million in free cash flow, and management guided Q2 to be roughly neutral, somewhere between negative $100 million and positive $100 million, that leaves a massive gap.
A huge gap.
Right. To hit their reaffirmed four-year guidance of $500 to $600 million in positive free cash flow, HII essentially has to generate roughly $1 billion in free cash flow in the second half of 2026 alone.
Yeah, and that is a monumental operational hurdle. Generating $1 billion in cash in just 6 months requires totally flawless execution.
So how do they actually clear that?
Management strategy relies almost entirely on achieving major milestones and actual ship deliveries in the back half of the year. They specifically need to deliver the SSN 800 Arkansas submarine and the LPD-30 Harrisburg amphibious ship.
So physically getting them out of the yard.
Exactly. Pushing those ships completely out of the yard triggers the final massive cash holdback payments from the Navy, which instantly converts those unbilled receivables into cash. And they are also relying on anticipated R&D tax credits dropping to the bottom line later in the year to kind of help plug that gap.
Got it. Now, to hit that 15% throughput target and process this insane $54 billion backlog, HII has clearly realized they cannot just keep hiring more green workers at their massive traditional shipyards in Virginia and Mississippi.
No, they just create more bottlenecks.
Right. So they are fundamentally changing how and where they build these ships to bypass these exact issues. Here's where it gets really interesting. I want to talk about their distributed shipbuilding strategy.
This is a huge shift for them. The Navy's acquisition chief actually recently visited Ingalls to review a $1 billion infrastructure investment aimed precisely at this, at decentralizing their manufacturing.
$1 billion just on infrastructure.
Yeah. Instead of doing everything at one primary mega shipyard, HII is spreading the structural fabrication and the outfitting across a much broader network of partner companies and offsite facilities.
Yeah, I like to think of it like building massive Lego sets. Instead of building the entire ship piece by piece in a single dry dock in Virginia, they're having a partner facility build, like a 400-ton, fully outfitted cross-section of the hull hundreds of miles away.
Right, and they just put that module on a barge, sail it up the coast, and simply snap it into place at Newport News.
It's wild. And the crown jewel of this distributed strategy right now is their new facility in Charleston, South Carolina.
Oh, the Charleston facility is absolutely critical for two major reasons. First, it completely bypasses the local labor bottlenecks we were just talking about.
Because Virginia is tapped out.
Exactly. The labor markets immediately surrounding Newport News and Ingalls are essentially exhausted. I mean, there are only so many welders and pipe fitters in those zip codes. By moving module fabrication down to South Carolina, HII taps into an entirely new regional pool of highly skilled trades workers, totally avoiding that 18-month proficiency gap. In its first year alone, the Charleston facility added nearly 500,000 man-hours of production, and management says they are slated to double that throughput in 2026.
Double it. That's massive. And the second reason for this geographic spread is risk mitigation, specifically against organized labor disputes.
Exactly. If you look at the 10K filing, it notes that roughly 45% of HII's 44,000 workers are unionized under collective bargaining agreement.
That's almost half the workforce.
Yeah. And in heavy manufacturing, work stoppages are just a permanent risk. HII has experienced some really painful strikes in the past, but by decentralizing production, if a strike happens at a primary yard in Virginia, well, their partner facilities in the Charleston yard and the distributed network can just keep fabricating modules.
Oh, so it doesn't shut down the whole operation.
Right. It creates a much more resilient, anti-fragile supply chain.
But they aren't just changing the geography of the build. They are fundamentally changing the mechanics of the yard itself. The financial models show them projecting capital expenditures at 3 to 3.5% of revenue, which is injecting hundreds of millions of dollars into what they call manufacturing centers of excellence.
Yes, and these centers are fascinating. They are basically retooling the industrial base with artificial intelligence and heavy robotics.
Robots building submarines?
Literally. The Navy has a really grueling requirement to eventually deliver 3 submarines per year to keep up with global fleet demands.
3 a year is incredibly fast.
And human labor alone, especially with that 18-month training lag, just cannot hit that cadence. So HII is deploying robotic welding systems and AI-driven supply chain management tools within these centers of excellence. The goal is to automate the structural fabrication that is currently bogging down the human workforce.
Which really points to the larger strategic inflection we outlined right at the beginning. HII is evolving way beyond physical shipbuilding.
Oh, totally.
You can see this clearly in their mission technology segment, which generated $748 million in the quarter. But I think the real proof of this evolution is a recent contract they won late in April 2026. HII won a $282.9 million contract for lead yard support and design development for the Navy's new Constellation-class frigate.
If we connect this to the bigger picture, what makes that specific contract so vital to understanding HII's future is that HII does not even build the Constellation-class frigate.
Exactly. Another competing shipyard builds the physical hull.
Right. So winning a $250 million contract to provide the engineering, design support, and sustainment for a platform built by a direct competitor. I mean, that is massive validation.
It's huge.
It absolutely proves HII is successfully transitioning into a fleet-wide technology and sustainment partner. They aren't just bending steel anymore.
Yeah, and when you combine that frigate support contract with their autonomous software systems, like their Odyssey platform.
Oh, the Odyssey platform is incredible.
Yeah, right. It's being developed alongside leading AI companies to control unmanned surface and underwater vessels. You just see a company aggressively pivoting. They are leveraging their historic monopoly in physical shipbuilding to dominate literally all maritime domains, physical sea, cyber, and autonomous tech.
So if you are looking at HII's portfolio right now and trying to make sense of this massive industrial giant, you really have to weigh these two competing narratives.
The volume giant versus the margin trap.
Exactly, because the forensic data absolutely points to a company experiencing a really painful 80 basis point margin drop, trapped in fixed price contracts and currently burning nearly $500 million in cash. But the operational roadmap suggests this is actually a temporary cost of scale, not a structural permanent ceiling.
Yeah, it all comes down to execution in these next 6 months for them. If HII can survive the 18 to 24-month labor proficiency gap where, their new hires are currently learning the ropes, and if they can hit that towering $1 billion second-half cash flow hurdle by successfully delivering the Arkansas and the Harrisburg,
then the underlying volume of that $54 billion backlog implies massive future profitability.
it really is a masterclass in the growing pains of heavy manufacturing and just the harsh realities of government contracting. I mean, it teaches a vital lesson for anyone analyzing industrial scale. A record-breaking $54 billion backlog and universal bipartisan government funding are completely meaningless if you do not have the skilled labor proficiency and the efficient, decentralized supply chains required to execute those contracts profitably.
That's the core of it.
Top-line volume does not automatically equal bottom-line success. It is the exact difference between a volume giant and a margin trap.
And, I want to leave you listening with a final provocative thought to mull over as this turnaround actually plays out over the next year or two.
Oh, I like where this is going.
We've seen that HII is investing incredibly heavily in AI and robotics through their manufacturing centers of excellence to bridge their labor gap and speed up production, right? But what happens to the dynamics of a heavily unionized, deeply traditional shipbuilding workforce when autonomous systems start performing the complex structural welding that has historically guaranteed their jobs? I mean, does this technological integration actually solve the labor bottleneck for HII, or does it just create an entirely new kind of systemic friction on the shipyard floor?
That is a fascinating question to watch unfold. Risk defined, portfolio protected.